Hello, everyone, and welcome. Thank you all for being here today. It is my pleasure to be presenting here at also virtually at the Small Satellite Conference. My name is Alexandre Najar. I am a senior consultant at Euroconsult, where I am in charge, among other things, of our prospects for the Small Satellite Market Intelligence Report. Today's topic will be consequences of COVID, of the pandemic on the small satellite market, and as well as how the unexpected availability of funding and capital has partly mitigated its impact. So we will dive into this subject today. Before we do, I would like to present a few things about who we are, about Euroconsult. So we've been there for over 35 years now, reaching 40 soon. We provide consulting services, market intelligence, research and data sets to our customers. We also provide executive trainings as well as summits, and we look forward to welcoming you this year in December at our famous World Satellite Business Week. Another piece of news for this year, we have opened a new office in Australia, and so we look forward to supporting your space businesses in the region. About our prospects for the small satellite market, so we like to call it the Smallsat Bible. It includes everything from Smallsat market drivers, industry trends, rationale and challenges for constellations, as well as technology and policy analysis. We provide an extensive data set with all satellites launched in the past 10 years, but also market forecasts 10 years into the future, broken down per satellite application, per orbits, per type of operators, prime integrators, launch providers, mass categories, you name it. We cover everything. We also have profiles of commercial smallsat integrators, a section dedicated to COVID, past market shares for manufacturing as well as launch services. And since this year, we introduced a premium product, which is our constellation database, in addition to the satellite database, which includes every single constellation project, smallsat in this case, including those that are not included into our forecast yet. The premium product as well includes an update at 6 months later than publication of the report for those that cannot wait for next year's edition. Now, let's dig into the agenda for today's webinar. I would like to get started with a few key figures from the report and a few trends for the smallsat market. Then we will see a few demand and supply drivers, both on the manufacturing side, but also for launch services, before discussing the impact of COVID and how funding from many different sources helps mitigate this impact of the pandemic. And then we will close off the webinar with a few key takeaways to keep in mind for the future. So, first, here you have our smallsat launch forecasts, where you can see how growth is expected to be more than fivefold over the future. We clearly see that smallsats have entered the maturity phase. They used to be more for experimental purposes in the past, but we now see many players, both commercial and government, developing and launching and operating smallsats for actually operational services and actual services from space. Some key things to discuss here is how the market demand is very concentrated, and I would say hyper concentrated by a few constellations. Beyond the impact of 2 mega constellations, which are namely Starlink and Kuiper from Amazon, the share of constellations is really important and drives the market in all metrics that we analyze, which is units, mass to be launched, as well as market value. You can also see that growth is not linear, as it's really depending on the launch cycle of constellations. For example, we anticipate a slowdown in Starlink launches as SpaceX focuses on service provision, ground segments, but also other efforts such as Starship. And once they reach a certain number of assets in space, they do not necessarily need to launch more satellites, as they need market take-up. They need to actually sell the capacity that they put in orbit. And we anticipate slower launches in the next few years as they focus on the business model. Another thing that has to be said is that market addressability does not grow on par with the number of satellites. Obviously, regional boundaries and market addressability considerations do apply, and vertical integration as well prevents some of the satellites to be addressed by commercial players. Finally, this is just a view in numbers of satellites. So it puts a CubeSat and a 500-kilogram satellite on the same level. The view is a lot different in terms of mass and market value, for example. So we highly recommend you to take a look at our report, where you will have all of this information very clearly stated out. Because obviously, commercial operators, for example, concentrate about 4/5 of the demand in terms of numbers of satellites, but not necessarily in terms of value, as they include more CubeSats, for example, which have a lower value. Then this infographic that you may have seen already on the Smallsat market, quite a lot of data to go through here, many things. So we can start with the share of the number of units depending on the status of the operator. As you can see, the growth is driven by constellations, but by commercial players as well. We can also see that the share of government, respectively, civil government and defense stay actually at 11% and 4% respectively of the total number of units over the future. This suggests that they also grow fivefold on par with commercial players, as government players, both civilian and defense, now start adopting small satellites for operational missions, with, for example, the SDA transport and tracking layer in the United States, or NASA adopting missions for space exploration purposes. And this is not only in the US, but also across the world. Many governments see the benefits of smaller, cheaper satellites to conduct their space missions. In terms of manufacturing and launch value, we see it increasing from $17 billion to $54 billion in the future, mostly dominated by manufacturing, which provides more revenue than launch services, which actually decrease in average value, but is compensated by a higher volume of missions. So 35 billion for manufacturing expected across over the next 10 years, with 19 billion for launch services. We also see the share of constellation missions increasing from 66 to 84%. And this is considering that the over 830 Starlinks launched in 2020 are actually counted in the past decade and represent much of the 66% over the past decade. In terms of regional boundaries, North America is set to concentrate demand, driven by Starlink and Amazon again. But it has to be said that we could revise Asia and China upwards actually in the future and in future editions of the report, driven by the Guowang constellation in China, pending more public information to be revealed on the project. In terms of applications, similar rationale applies, with telecom leading growth for small satellites, followed by Earth observation and technology demonstration satellites in a third position, as Smallsats are an ideal form factor, I would say, to test new hardware, new antennas, new thrusters for a fraction of the cost of previous demonstration missions in the past. Now let's move to some structural demand and supply drivers. I would like to start with some insights on manufacturing, and in particular, manufacturing market value. So as I said before, vertical integration is a real challenge on the manufacturing side and increasingly challenges existing supply base and commercial providers. You can see the share of in-house production within the market value increasing from 22 to 33% of the total market value, with a caveat, which is that the 36% of open market value that we see over the next 10 years that remains. Obviously, we don't know what type of operator, prime integrator, sorry, they will go to. So this 36% still has to be spread across the different types of integrators, possibly impacting this chart, obviously, as time goes on and as contracts are signed. We are set to know more about this breakdown. So other thoughts on this graph? Well, as you can see, the pure smallsat manufacturers, which often work with CubeSats and limited size CubeSats, do not concentrate large shares of the value, despite some level of growth in absolute terms. Their share of the total market is set to decrease as other type of integrators see fastest growth and will concentrate more contracts and more market value as it concerns larger satellites that are often more expensive. And finally, one word of warning on this slide: it considers market value at the satellite level, taking a satellite as a whole, but this is not a market value breakdown at the subsystem level, which is to say that market addressability concerns, for example, are not the same at the subsystem level. As in, you could sell, for example, a thruster or an antenna to a constellation that is, for example, vertically integrated. It is possible to sell a solar panel, to sell some pieces of hardware, and this is not taken into account into this graph, which means that there remains significant opportunities to be made by satellite integrators as well as subsystem providers, despite this vertical integration trend. Now, so moving on to this slide on launch services, this is the launch demand and supply distribution over the past decade. And I think that it is really significant for the smallsat market for many reasons. It showed that launch and launch demand for smallsat was a global marketplace. However, we really expect it to decrease in the future for several reasons. So this was driven by a lack of launchers, by a bottleneck in access to space that we believe is being reduced today and very rapidly, given the expected availability of numerous smallsat launchers, whether micro launchers, small launchers, or heavy launchers, offering rideshare opportunities, whether dedicated or in addition to their main payload. So you could see, for example, about a fourth or a third of US demand going to Russia and Soyuz, to India and PSLV, and even to Europe sometimes. This is, we expect it to be greatly reduced, and actually this was an incentive for the development of micro launchers in the US. So we expect domestic demand retention to be a lot higher in the future, especially, for example, in the case of the US with SpaceX rideshare on Falcon 9, with a very low cost, which limits incentives to go abroad to launch your small satellites if you're a US satellite operator. So now let's dig into the key topic of today's webinar, which is the COVID pandemic and how it was essentially mitigated so far, I would say, by unexpected funding availability. So obviously, COVID has had an impact. It was, we're not saying that they did not have an impact. We're just saying that the impact was more limited than we expected. Initially, we really were expecting consolidation within the industry, business failure, M&As, which nonetheless happened. We can quote, for example, OneWeb as the largest and flagship bankruptcy that happened over the past few months. But as you know, OneWeb survived, OneWeb was acquired and has raised billions of funding since. So it actually came out strengthened than before the pandemic. They actually raised another $300 million today from Hanwha Systems in South Korea. So obviously there were closures, working from home, disrupting production activities, spaceports that were closed, programs that were delayed, government pivoting to other more urgent domains in healthcare, for example, as well as investors kind of looking away, which was one of the reasons for the OneWeb bankruptcy. But overall, the space sector was really resilient. The companies that went bankrupt, most of them were acquired and started with a fresh balance sheet, I would say. And actually, the pandemic so far only accelerated trends that we believe were pre-existing before the pandemic. So I would say that it may have been a lot of trouble for early stage players, but market leaders such as Starlink and SpaceX, for example, kept launching throughout the pandemic at very impressive launch rates. Amazon, which is behind Project Kuiper, made records amount of money. So leaders will really, in our opinion, come out strengthened than before the pandemic. This is due to three main sources of funding, actually, that were unexpected, as I said. And we will dig into it right away. So first, I would say we had record amounts of traditional fundraising, traditional as in classical venture capital or equity raising by companies. So this is a small extract from our space market monitoring monthly report, actually from the June edition of the report. And as of June of 2021, we have already surpassed the 2020 level of investments, which was already a record year. So as of June, as of mid-year, we are already breaking records, despite the pandemic, which is quite surprising, in my opinion. And one thing that we noticed is a higher than average number of rounds that are in the hundreds of millions, so 9-figure rounds. OneWeb, as I said, has raised significant amounts of money. Relativity Space has raised over 650 million. Climate Vision emerged from stealth mode with a 100 million round, and they are not the only ones. And we do not see any sign of slowdown yet. Another thing that to take into account on this slide is that Blue Origin is not included. We could actually consider Jeff Bezos as a fourth source of funding, and SPACs are not included either, as they are another source of funding that we will address right away. So in addition to this classical source of funding, we have record government investment in space. Another few extracts from our government space programs this time. The number of countries investing in space is reaching a record 85 countries, although it is a bit plateauing over the last 2 to 3 years. And this is partly thanks to Smallsats. We have many emerging countries launching their first satellites due to the affordability enabled by the small satellite form factor. Many emerging countries launching their first satellites, CubeSats or higher mass satellites, whether for technology demonstration purposes, but also for operational services. And we see worldwide that the space expenditures of governments are steadily increasing. And are expected to keep increasing over the next few years, both on the civilian side, so space agencies, research institutes, then on the defense and military side, with militaries less and less reluctant to adopt small sats, in part due to the need for resilient architectures, as the SDA has said numerous times. And finally, the most unexpected source of funding, I would say, is the SPACs. So the SPACs trend. So SPACs are actually not something new. The mother of all SPACs, I would say, was Iridium back in 2008. So not small sats, but SPACs are now clearly redefining the fundraising landscape, I would say, for small sat ventures. As I would say 90% of the recent SPACs do concern small sats or small sat related companies, enabling, again, funding rounds in the hundreds of millions. You can see market leaders such as Planet raising over $500 million. And this is really significant as, well, it wasn't expected for once, and it enables companies that sometimes could not or did not want to go through traditional IPO due diligence processes to raise significant amounts of funding, unloading some of the risk on investors rather than their own, I would say, balance sheets and institutional investors. So a word of warning about SPACs: they are obviously a great thing for space companies as they enable significant amounts of funding to be raised. And they could maybe enable some companies to go through what we call the funding valley of death. So before revenue generation, when you spend significant amounts of money to actually design, develop, and manufacture and launch your hardware into space. However, investors must be aware of some of the revenue projections that were published recently for many SPACs that are sometimes very overly optimistic, claiming future revenues in the billions and billions of dollars. So most have to be taken with a pinch of salt. Beware, and actually it deserves digging into the business models and seeing what they can do. And another thing about funding is that funding remains funding. It is not actual customer demand. It is not actual contracts. It is not revenue generation. So unless it enables a move towards revenue generation, either through internal growth, I would say, or M&As and acquisitions of companies that already have a cash flow and a revenue generation and some amount of profitability, SPAC funding, it does not make a business model. It is not a substitute for revenue generation. However, it can help you get you there if you stick to developing your business. And finally, what I would like to say about SPACs is it a 2021 thing? Are SPACs here to stay, or is it a temporary thing? It is too early to say, but can the failure of one or several of them actually slow down investor interest for SPACs, or actually a big risk would be that they limit interest for the whole space sector beyond SPACs? We do not have the answer to this question, but this is certainly a question to be raised. This is a risk. Now let's conclude the webinar with some key takeaways. So again, on the share of the mega constellations, we have seen that mega constellations concentrate massive share of the number of satellites to be launched, but they do not necessarily concentrate significant shares of market value. So due to massive economies of scale and very low manufacturing and launch costs. If we take Starlink as an example, we anticipate that they will launch their Starlinks at 260 kilogram of mass for the cost of CubeSat class satellites, which is pretty impressive and enabled by a very disruptive design on the manufacturing side, but also launches of large batches of satellites on reusable launchers. So they do not concentrate as large shares of market value as they do in terms of units and mass to be launched. So there really remains significant opportunities in terms of market values, for commercial and government customers alike. With the caveat that most of the market value is captive of government demand, government customers. Part of it is due to the larger cost per satellite of government smallsats, due to more requirements in general, or more state-of-the-art payload compared to low-cost commercial CubeSats, I would say. And effectively, governments still account for more than half of the market value of the 54 billion we expect over the next 10 years. This does not mean that commercial value is negligible. We still have more than a fifth of market value to be captured by commercial players, and actually this is something that grows from one edition to the other of our report. We see the share of government value decreasing while commercial increases. And as I said before, this is just an analysis at the satellite level. So at the subsystem level, significant opportunities still exist, whether you manufacture laser links or satellite thrusters for electric propulsion. Opportunities are multiple, and there remain a lot of market value to be captured over the next decade. Finally, a few words to close the webinar. The smallsat market keeps growing at a tremendous rate, but is very concentrated by a few stakeholders, which means that market growth is not so evident for many commercial players, both on the manufacturing and on the launch side, as new entrants sometimes struggle with market addressability considerations. For example, well, in-house manufacturers that cannot be addressed, or just regional concerns. For example, Chinese constellations are not addressable to many players, and this goes vice versa, I would say. So vertical integration is a real challenge. Competition is very intense. We see many players, both on the satellite operation side, but also in manufacturing and launch. We see many players that have the same value proposition, which means that differentiation, either for hardware or services or pricing, remain very important to stay ahead of the competition. Again, the COVID-19 induced market rationalization that we expected did not occur, or occurred, but was much more limited than we thought. But a word of warning on this: could it maybe have only been delayed for a while? Because as for the SPACs, I am no pandemic expert, but maybe COVID is not over. Maybe COVID is here to last. Maybe it is just a 2021 thing. We do not have the answer yet. It is too late to answer the question, but a word of warning, as we are not, the pandemic is not behind us yet. On SPACs, well, they represent for sure an opportunity for space companies, allowing to raise significant amounts of funding, yet many investors could become disillusioned with space investments. We had the momentous example a few weeks ago actually resulting in a lawsuit and investigation by the SEC, which meant that the SPAC value and the amount of money that Momentus could raise were actually divided by 2. So going forward, we hope this will not happen to other SPACs, but it remains a possibility. And finally, well, government support is and remains very important, whether under the form of pandemic relief initiatives or actual traditional hardware or service provision, not pandemic related, but under the form of contracts and demand and actually revenue generation. I think it is more, it shows more to the value of the company's business model than pure funding, as the SPACs do. So with these words, I would like to thank you for your attention, and I would be happy to answer any questions that you might have. Thank you very much.